journey and you're theirs too. Like sweet tea when they turned in, the staring down to mute, and can learn to pull their chunky died.
When most people begin their journey in tax, they focus on memorizing tax rates, studying tax tables, and learning rules of thumb. That's a natural starting point. But it's not how professional tax planning is done. On the left side of this slide, we see the traditional tax preparer mindset. The focus is on percentages, charts, calculations, and compliance. The common question is, what percentage should I use? While this knowledge is important, it only helps you prepare returns. It does not help you design better outcomes for clients. The real transformation happens when you shift from being a tax preparer to becoming a tax planner. Instead of focusing on individual numbers, you focus on strategy. Instead of memorizing rules, you build a repeatable process. Instead of simply reporting the past, you help shape the future. This is why modern tax planners rely on tax software, scenario analysis, and client-specific planning. They compare different options, evaluate trade-offs, and consider the client's family situation, business goals, retirement plans, and cash flow needs. The key question changes from what percentage should I use to which option creates the best outcome for this client. At the bottom of the slide, you'll see the 4-step planning process. First, understand the client's situation and goals. Second, analyze the numbers using professional tax software. Third, compare all impacts, including corporate tax, personal tax, CPP, RRSP implications, and cash flow. Finally, present recommendations and explain the trade-offs so the client can make an informed decision. The most important lesson from this entire module is simple. Do not focus on memorizing numbers. Focus on mastering a repeatable planning process. Tax rates will change. Rules will evolve. But a strong planning methodology will remain valuable throughout your entire career. That is the mindset shift that transforms a tax preparer into a trusted tax advisor. Now that we've made the mindset shift from tax preparer to tax planner, the next question is, what exactly should we analyze when designing a compensation plan for a corporate owner-manager? Many beginners make the mistake of looking at only one piece of the puzzle. For example, they focus only on personal tax, only on corporate tax, or only on CPP. Professional tax planning requires a much broader perspective. At the center of this framework is the most important question every owner-manager asks. How should I pay myself? The answer is never based on a single factor. Instead, it requires balancing multiple interconnected planning areas. First, we have corporate tax. Salary is deductible to the corporation, which can reduce taxable income and lower corporate tax. Dividends, on the other hand, are generally not deductible. This means every compensation decision affects the corporation differently. Second, we must consider personal tax. Salary and dividends are taxed under different rules, and the actual tax outcome can vary significantly depending on the client's situation. Third is CPP. Salary creates CPP contributions, while dividends do not. Although CPP represents a cost today, it can provide valuable retirement benefits in the future. Fourth, we have RRSP room. Salary creates new RRSP contribution room, helping clients build future retirement savings. Dividends do not generate new RRSP room, which can influence long-term planning decisions. Fifth is client cash flow. Tax planning is not just about reducing taxes. We must understand how much money the client needs, when they need it, and how their lifestyle affects those requirements. And finally, we consider future goals. Clients may be planning for a mortgage, retirement, education funding, or supporting their family. The best compensation strategy must align with these broader objectives. The key lesson is that none of these factors can be analyzed in isolation. Every compensation decision creates ripple effects across the entire financial picture. A change that improves one area may create consequences in another. That's why great tax planners think in systems, not in shortcuts. They evaluate corporate tax, personal tax, CPP, RRSP opportunities, cash flow needs, and long-term goals together before making a recommendation. When you start viewing compensation planning through this complete framework, you move beyond simple tax calculations and begin delivering truly valuable advice to your clients. Now that we understand the mindset of a tax planner and the key factors that influence compensation decisions, let's look at the actual process professionals use when planning with clients. One of the biggest differences between a beginner and an experienced tax advisor is that experienced advisors follow a consistent methodology. They don't rely on guesses, shortcuts, or rules of thumb. Instead, they follow a repeatable process that can be applied to virtually every client. The first step is to understand the client. Before running any calculations, you need to gather information about their family situation, mortgage plans, children, education goals, retirement objectives, health concerns, disabilities, and any other sources of income. The most important principle here is simple. Start with the person, not the numbers. Once you understand the client's situation, the second step is to build scenarios. Instead of assuming there is one correct answer, create multiple possibilities. Typically, you'll compare an all-salary approach, an all-dividend approach, and a hybrid salary and dividend strategy. This allows you to explore different outcomes rather than locking yourself into a single solution. The third step is to analyze the results. This is where professional tax software becomes essential. You compare the real impact of each scenario, including corporate tax, personal tax, CPP contributions, RRSP implications, and the amount of cash the client ultimately receives. The goal is not to find the lowest tax number in isolation. The goal is to understand the complete financial impact of each option. The fourth step is to present choices. A professional advisor does not simply tell the client what to do. Instead, they explain the advantages and disadvantages of each scenario, answer questions, discuss trade-offs, and provide recommendations. Your role is to educate, not dictate. The fifth and final step is the client decision. Once the client understands the options and the consequences of each choice, they can select the path that best aligns with their goals, preferences, and comfort level. A successful plan is not necessarily the one with the lowest tax bill. It is the one that best supports the client's overall objectives. At the bottom of the slide, you'll see the complete progression. We begin with tax returns and client facts. We combine that information with professional expertise and tax software. We run multiple scenarios, compare outcomes, and ultimately help clients make confident, informed decisions. This is the process that transforms a tax preparer into a trusted advisor. When you master this methodology, you stop focusing on isolated calculations and start delivering meaningful value. The real goal is not just preparing returns. The real goal is helping clients make better decisions, achieve better outcomes, and build long-term financial success. Master the process, and the results will follow.